Welcome to Talk Tickers. Today, we are not just looking at a standard financial instrument. We are looking at the architectural blueprint of modern risk.
Yeah, that's a good way to put it.
We're basically stripping the paint off the walls of the global banking system to see the actual wiring underneath.
Right.
Because today we are covering an instrument that is simultaneously this masterpiece of financial engineering, a really legitimate scalpel for balance sheet management, and, as history has obviously shown us, a potential weapon of mass destruction if it's in the wrong hands.
It is the scalpel that became a bomb. I mean, that's really the only accurate way to describe the trajectory of this thing.
That is the perfect image. So for this deep dive, I want you to imagine a scenario. Say you're a hedge fund manager, you have a thesis. You firmly believe that corporate credit is going to crash.
Okay.
And you want to bet against the creditworthiness of, let's say, 100 different companies. Ford, IBM, General Electric, you name it. But you have a massive problem. You do not have the capital to go out and short 100 different physical bonds.
You absolutely don't. The margin requirements alone would completely kill you.
Exactly. You'd need billions in balance sheet capacity just to put that trade on.
Right, because the logistics in the cash market are a nightmare. You have to go find the specific bonds. You have to borrow them from a repo desk.
Which involves fees.
Heavy fees. Then you sell them into the open market, and you just have to pray you can buy them back cheaper later on.
Yeah.
It's high friction. It's very expensive. And frankly, sometimes the bonds you want to short just aren't available to borrow at all.
Or, let's get even more aggressive with the analogy. Let's go back to 2006. Imagine you want to short the U.S. housing market.
The classic example.
Right. You can't exactly walk up to a house in Florida, knock on the front door, and tell the homeowner, "Hi, I'm betting you are going to default on your mortgage." You cannot short a physical house.
No, you can't. In the physical market, you are strictly limited by reality. You can only trade what actually exists. You can't short a house, and you certainly can't buy a bond that hasn't been issued by a company yet.
So this brings us to the core question of our deep dive. How do you strip out just the risk that you want, the credit risk, without buying, selling, or even touching the actual underlying asset?
Can you trade the ghost of the asset?
Exactly. How do you trade the ghost? The answer to that lies in one of the most engineered, powerful, and notoriously misunderstood instruments in modern finance, the synthetic collateralized debt obligation, the synthetic CDO.
And we need to be very, very clear right up front for everyone listening. This isn't just a history lesson about 2008,
right? Though
obviously that is the elephant in the room. But this is fundamentally about understanding pure risk transfer. This is exactly how global banks clear their balance sheets today, right now.
Is how the plumbing works.
Yes.
Yeah.
This is how hedge funds juice their yields when interest rates are flat. If you do not understand the synthetic CDO, you really don't understand how credit moves around the world.
So we are going to strip this down to the studs. We're going to cover the definition first, what it is versus a traditional cash CDO. Then we'll look at the actual mechanics, the SPV, the CDS, and the tranches.
The plumbing.
The plumbing, exactly. Then we'll get into the pricing and the math, specifically the dark magic of correlation.
Which is where things get really interesting.
Oh, absolutely.
Yeah.
Then we'll do the history, from the JP Morgan Bistro deals in the late 90s all the way to the subprime crisis. And finally, we'll look at the investor context. Why does the smart money use them? And where are the bodies buried?
The bodies are usually buried deep in the footnotes or in the correlation assumptions.
So let's start at the very top. Give us the baseline. What exactly is a synthetic CDO?
At its absolute core, a synthetic CDO is a financial structure that replicates the economic exposure of a portfolio of debt assets.
So things like corporate bonds or loans?
Exactly. It replicates that exposure using credit derivatives, specifically using credit default swaps, or CDS.
I think replicates is the key word to focus on there.
It is the entire distinction. Look, in a traditional cash CDO, the issuer actually goes out into the real market and buys the bonds. They own the physical paper. If they want to build a CDO out of 100 corporate bonds, they literally have to purchase 100 corporate bonds.
They hold the legal title.
Right. They collect the actual coupon payments directly from those companies.
Okay, so in a cash CDO, there is a vault somewhere, metaphorically speaking, filled with actual promissory notes from Ford and General Motors.
Correct. But in a synthetic CDO, the issuer doesn't own the debt.
Not a single bond.
Not a single bond.
Correct.
They just hold the risk of the debt. They use credit default swaps to gain exposure to those 100 companies. It's a complete simulation of ownership, financially speaking. I always like to say it's like the difference between owning a racehorse and holding a betting slip on that racehorse.
I love that analogy because in both cases, if the horse wins, you make money. And if the horse breaks a leg, you lose money. But in the second case, with the betting slip, you don't have to actually feed the horse. You don't have to pay the jockey. You don't have to find a stable for it.
Precisely. You completely remove the operational burden of ownership. You just have the pure economic exposure to the outcome. You have surgically stripped the credit risk away from the physical asset itself.
So why? I mean, why go through the trouble of simulating it? Why not just buy the actual bonds? It seems like a massive amount of legal and financial engineering just to avoid buying a piece of paper.
Well, there are two main reasons, and it really depends on which side of the table you sit on. Let's start with the issuer. Usually this is a massive global bank. Think JP Morgan, Citi, Deutsche Bank. For them, it's almost entirely about regulatory capital relief. This is the primary mission of the instrument from a banking perspective.
Okay, let's unpack that. Regulatory capital relief. It sounds very dry, but it's basically what makes the entire banking world go round, right?
It absolutely is. Banks have incredibly strict limits set by things like the Basel Accords and local regulators on exactly how much risk they could hold against their capital reserves.
Because regulators don't want banks going under if a few loans go bad.
Right. So if a bank has $1 billion of corporate loans on their books, they have to hold a certain amount of cold, hard cash in the vault, that's the regulatory capital, against those loans to absorb potential losses. Let's say the requirement is 8%.
Okay, so for every $100 they lend out to companies, $8 has to just sit there in the vault doing absolutely nothing.
Exactly, which is dead money.
Yeah.
It's sitting there, it's not earning a return, it's just acting as a buffer.
And that drags down their return on equity, their ROE.
Massively. And banks are fundamentally in the business of leverage. They want to lend as much money as physically possible with as little of their own equity tied up as possible. Now, the bank could simply sell those loans to another bank to free up that 8% capital.
But banks hate selling loans.
They despise it because if you sell a loan that you originally made to IBM, well, IBM finds out. They get a notice and they call up and say, hey, why is Bank of America suddenly holding my loan? I thought I had a relationship with you. It damages the core client relationship.
They are completely stuck. They can't sell a loan because it upsets their best clients, but they can't afford to keep the risk because it ties up all this precious capital.
Enter the synthetic CDO. By using this structure, they can transfer the credit risk of those loans to outside investors via a swap without ever actually selling the underlying loans.
Wow.
Yeah. They keep the client relationship. The loan technically stays on their balance sheet, but the risk of that loan defaulting is moved entirely off-site. The regulators come in, they look at the books and say, okay, you still have the loan, but we see you've completely hedged the risk through this derivative. You can go ahead and release that 8% capital.
And then the bank can take that freed up capital and go lend it out again to make more money.
Exactly. So for the bank, it's purely about balance sheet efficiency. It's regulatory arbitrage. They have to have their cake and eat it too. Keep the client, lose the risk.
Okay, so that makes perfect sense for the bank. But what about for the investor on the other side? Why would I, as a hedge fund or a pension fund, want to buy a synthetic exposure instead of just buying a real tangible bond?
For the investor, it's all about yield enhancement and, crucially, customization. Think about the cash market. You are strictly limited by what is currently for sale. You want to buy a bond from General Electric, but nobody in the market is selling one right now, or maybe the specific 5-year maturity you want just doesn't exist.
You're just out of luck.
Right. You are completely at the mercy of supply. You can't buy what isn't sitting on the shelves.
But in the synthetic world,
you can basically play God. You can create a portfolio of credits that doesn't actually exist anywhere in the cash market. You can access assets that are highly illiquid or incredibly hard to source. You can build a completely bespoke portfolio of risk.
it sounds like the difference between buying a pre-built house in a subdivision versus printing a custom house on a 3D printer.
That's a very fair analogy. You can print exactly the risk profile you want. Say you want exposure to strictly European tech companies, but only ones with BBB ratings, and you want exactly a 7-year maturity.
which might be impossible to find in physical bonds.
Almost certainly impossible. But you can synthesize that exact portfolio instantly using swaps, even if those companies' bonds are privately held or just not trading that day.
Now, within the synthetic world, there's a major distinction between funded and unfunded deals. This seems like a minor technicality on the surface, but I suspect it's actually vital for understanding who is really holding the bag if things go wrong.
It is absolutely crucial for understanding counterparty risk. Yeah. Let's start with an unfunded synthetic CDO. This is essentially just a raw swap contract.
Just a piece of paper between two parties?
Exactly. No actual money changes hands initially. I agree to pay you $10 million if IBM defaults, and in exchange, you agree to pay me a quarterly premium. It's pure counterparty risk.
Yeah.
If IBM goes bust, but I also go bust at the same time, your protection is completely worthless.
It's basically, trust me, I'm good for it.
Right. And that works fine when everyone is solvent. This is typically how massive banks trade with each other. They trust each other's balance sheets. But when you are selling this risk down to regular investors like pension funds, regional asset managers, smaller hedge funds, you need something way more robust.
Because they don't have the balance sheet to just say, trust me.
Exactly. And that's where the funded structure comes in. In a funded synthetic CDO, the investor actually has to put up cash, the principal amount up front on day one. Let's say you buy a $10 million slice of a synthetic CDO. You literally wire $10 million in cash to the issuer.
Okay, but where does that money actually go? If the issuer isn't using it to buy physical bonds, where is it sitting?
That cash doesn't just disappear into the bank's general ledger. It sits in a dedicated, ring-fenced collateral account. And it's usually invested in something incredibly safe and highly liquid, almost always U.S. Treasuries or AAA-rated sovereign debt.
So it's completely distinct from the risky corporate portfolio you are actually betting on.
Yes, the underlying bet might be on risky tech startups, but your actual cash is sitting in government bonds.
So the cash is basically sitting there in escrow, earning a risk-free interest rate.
Exactly. And that collateral serves two massive purposes. One, it generates some steady interest income, that risk-free rate, which helps pay the quarterly coupon to the investor.
And the second purpose?
The second and most important purpose is that it completely eliminates the risk that the investor just walks away when things go really bad. If those reference tech startups actually start defaulting, the issuing bank doesn't have to hire lawyers to chase the investor down for the money.
They already have it.
They just dip into the collateral account and take it.
So it's basically prepaid insurance.
Ideally, yes. It fully secures the protection. The bank sleeps well at night knowing the money is physically there.
Okay, let's really pop the hood here. I want to understand the actual mechanics. We've got this abstract concept of transferring risk, but how does the plumbing actually work day to day? What are the specific ingredients? Because when financial people talk about CDOs, they use a massive amount of acronyms.
They do, but it really boils down to three main components. First, you have the SPV, the special purpose vehicle.
Ah, the famous SPV. The ghost in the machine.
Ghost in the machine. An SPV is a bankruptcy remote legal entity. It's a literal company created solely for this one specific transaction. It sits right in the middle of everything. It has no actual employees. It has no physical office. It's usually just a registered mailbox in the Cayman Islands or Jersey or Delaware.
And what does this mailbox actually do?
Its only job is to sell the notes to the investors on one side and sell the credit protection to the bank on the other side. By doing this, it legally isolates the risk of the transaction from the overall risk of the bank itself.
So it's a firewall. If the massive global bank fails for some unrelated reason, the SPV is safe. And if the SPV fails because all the underlying companies default, the bank is safe. It's an airlock.
In theory, yes. It legally separates the assets and the liabilities. Okay, so component number 2 is the reference portfolio.
The actual list of names.
Right. This is the specific list of companies or credits you are betting on. Typically, a standard synthetic CDO will reference exactly 100, maybe 125 entities. These could be big corporations, they could be sovereign governments, or as we unfortunately saw in the mid-2000s, they could be residential mortgage-backed securities, RMBS.
So this is the literal list of horses in the race.
Correct. And finally, the third component is the engine driving the whole thing. The credit default swap, the CDS. We need to be very, very clear on how a CDS works in this context because it is the fundamental building block of the entire structure.
Right. Walk us through it. In a CDS, you have a protection buyer and a protection seller.
Exactly. The protection buyer is usually the bank looking for capital relief, or maybe a hedge fund trying to short the market. The buyer pays regular premium, which is called the spread. usually quarterly.
Like paying your car insurance premium every month.
Exactly like that. And in exchange for those payments, they get a massive payout if a credit event happens to one of the companies in the reference portfolio.
Now, a credit event isn't just a subjective, oh, they look like they're running out of money. It's a very strict legal definition, isn't it?
Extremely strict. It's defined down to the letter in the ISDA documentation. That's the International Swaps and Derivatives Association. The lawyers spend months arguing over these definitions. Usually, a credit event is triggered by three things: formal bankruptcy, failure to pay a scheduled debt obligation, or a formal restructuring of their debt.
So if one of those specific legal triggers is tripped?
If one is tripped, the protection seller, the investor who bought the CDO note, has to pay up. They've been receiving those nice premium payments all along, but the second the default hits, they have to pay the buyer the par value of the bond minus whatever the recovery value is.
Okay, let's talk about that payout mechanism, because as an investor, you don't just buy the risk of the whole portfolio equally, right? You don't just say, I'll take a flat 1% of the risk on these 100 companies. You buy a specific slice of the risk.
And this is the absolute genius and, frankly, the incredible danger of the CDO, the tranche structure. It's often called the waterfall. You take the total risk of that entire 100-name portfolio and you slice it horizontally. You're essentially prioritizing exactly who takes the first hit when a punch lands.
Walk us through those slices, starting from the very bottom of the waterfall.
At the very bottom, you have the equity tranche. This is also known in the industry as the first loss piece. It usually covers the very first 0% to 3% of any losses in the total portfolio.
Okay, so just to put numbers to it, if you have a $1 billion synthetic portfolio, the equity tranche is on the hook for the first $30 million of losses.
Correct. And because it absorbs the very first default that happens, and the second default and the third, it is inherently the riskiest slice. It is highly, highly likely to take at least some kind of hit over a 5-year period.
And because it's so risky, it pays the most.
Exactly. Because of that extreme risk, it pays an absolutely massive coupon, sometimes 20% or more. This is exactly where you see aggressive hedge funds playing. They are looking for massive leverage and high yield.
They are essentially betting that the economy will be pristine, that defaults will be practically zero.
Right. So if nothing happens, if the economy hums along, the equity tranche is an absolute gold mine. You're getting a 20% yield for taking a risk that never actually materialized.
That's high risk, incredibly high reward.
But, and this is a mass, but if just a couple of companies in that list of 100 go bust, your entire principal is gone, wiped out to zero. You lose everything.
Okay, moving up the stack. Who is above the equity guys?
Next up is the mezzanine tranche. This usually covers losses from that 3% mark up to maybe 7 or 10% of the portfolio. This slice only starts taking a loss after the equity tranche is completely 100% wiped out.
So the equity guys are quite literally the human shields for the mezzanine guys.
Precisely. The equity absorbs the initial barrage. So the mezzanine investors are sleeping a little bit better at night. Because of that buffer, they often get investment grade ratings from the agencies. They get a BBB or even an A rating.
Even though they are still exposed to significant leverage, which we will definitely discuss later.
Yes, the rating masks the leverage, but they get a lower yield than the equity guys, obviously, but a much higher yield than the truly safe stuff. This mezzanine slice was the absolute sweet spot for thousands of investors in the mid-2000s. It felt very safe because of the rating, but it paid a really nice premium.
And then at the very top of the waterfall,
the senior and super senior tranches. This makes up the vast bulk of the deal, usually 80 to 90% of the entire capital structure. These slices only lose a single dollar if a massive catastrophic chunk of the portfolio defaults.
We're talking a total systemic economic collapse.
Right. Because they are so heavily insulated by both the equity and the mezzanine buffer sitting below them, they are almost universally rated AAA. But the trade-off is they yield very little, sometimes just a tiny few basis points over the risk-free rate, like LIBOR or, say, a SHFR.
So in a normal functioning world, the super senior tranche is incredibly boring. It's basically just cash management. It's where a pension fund puts money they absolutely cannot afford to lose.
It's supposed to be boring. It's supposed to be entirely money good. The statistical probability of a loss hitting the super senior is calculated by the models to be infinitesimally small.
Unless, of course, the model is wrong.
Unless the model is wrong.
Now, when a default actually happens, let's say one of the 100 companies in the portfolio formally files for bankruptcy, how is that actually settled in a synthetic structure? We mentioned that funded deals have cash collateral sitting there, but what is the actual mechanical process of the payout?
There are three main ways the market handles this. First is physical settlement. This is the very old school way of doing it. The protection buyer literally hands over the physical defaulted bond to the protection seller, and the seller hands over a check for the full face value.
Literally, here's the piece of junk paper, please give me my $1 million.
Exactly, it's a direct exchange. But in synthetic CDOs, especially the ones referencing broad indices or specific loans, that physical exchange can be incredibly clumsy.
Because you might not actually own the bond.
Exactly. If you just bought a CDS to speculate, say you shorted General Motors, but you never actually owned a GM bond to begin with, you literally cannot hand a bond over. You don't have one.
So the system breaks down.
It would, which is why they invented the second method, cash settlement.
How does that work in practice?
When a company defaults, the industry holds a massive centralized auction to determine the actual market recovery value of that defaulted bond. Let's say the market decides the GM bond is currently trading at 40 cents on the dollar after the bankruptcy filing.
Okay.
The protection seller simply looks at that auction price and pays the buyer the difference between par, which is 100 cents, and the 40-cent recovery value. So they just wire over 60 cents on the dollar in cash. No physical bonds ever change hands.
That seems vastly cleaner.
It is vastly cleaner.
Yeah.
And critically, it allows for virtually limitless speculation. Because you don't need the scarce physical asset to settle the bet, you can have 100 different people betting on the exact same bond.
Wow. Okay, and what's the third settlement method?
The third is a structure that became very, very common in asset-backed securities called pay-as-you-go. Pay-as-you-go.
Pay-as-you-go. That sounds like a chill cell phone plan. How is that different from cash settlement?
It was designed to address a very specific structural problem with mortgages. See, in corporate bonds, a company usually just defaults once. They file for Chapter 11. It's a binary one-time event. But in a massive portfolio of residential mortgages, the losses don't happen all at once. They trickle in very slowly over time.
Right. A few homeowners default in March, a few more default in April, maybe a dozen in May.
Exactly. You can't just call a credit event and settle the whole billion-dollar structure on day one. So the PUAG mechanism allows the protection seller to just pay out small amounts of cash as the actual losses are realized on the underlying mortgages, rather than waiting for one massive terminal event. It mathematically mirrors the exact cash flow decay of the actual physical mortgage bonds.
Got it. Keeps the synthetic version perfectly aligned with the messy reality of the cash version over time.
It tries to, yes. It prevents the synthetic contract from drifting too far away from the reality of what the underlying homeowner is actually experiencing. It makes the synthetic CDO behave almost identically to the cash bond, payment for delayed payment.
Okay, I want to pivot to the math for a second here. Because whenever you hear people talk about CDOs in a deep way, you hear this word correlation constantly. It's always whispered like it's some kind of dark magic. Why is correlation considered the secret sauce of a CDO?
Because when you are looking at a portfolio of 100 different companies, the risk of the portfolio isn't just about the individual default probabilities of each company.
Right. It's not just what are the odds Ford goes bankrupt.
Exactly. The real risk is about joint default probabilities. Will they die together? That is the billion-dollar question that drives everything. If Ford defaults on Tuesday, does that mathematically mean General Motors is highly likely to default on Wednesday?
Give us the extremes. What does high correlation actually look like?
High correlation. Let's say a correlation of 1.0 means all the assets act as a single unified block. If one survives, they all survive. If one defaults, every single one of them defaults at the exact same time. It's a monolithic entity. Think of it like a line of dominoes that are physically glued together.
So it's completely all or nothing.
Right. Now, think about who wants that scenario. If you are the senior tranche holder, the guy sitting way up at the top of the stack with the AAA rating, you absolutely hate high correlation.
Because your only actual risk is a total systemic collapse.
Exactly. You have a massive buffer of equity and mezzanine sitting beneath you to absorb individual shocks. The only way you ever lose a single penny is if everything goes wrong at the exact same time. So high correlation is your mortal enemy. You desperately want diversification. You want extremely low correlation. You want a world where if IBM completely fails, Ford is still totally fine.
But if I'm the equity tranche holder at the bottom...
This is where it gets incredibly counterintuitive. If you are the equity holder, You actually love high correlation. You pray for it.
Why?
Remember, you are holding the very first 3% of losses. If defaults in the economy are totally random and uncorrelated, meaning low correlation, it is almost statistically guaranteed that in any random pool of 100 companies, over 5 years, 2 or 3 of them will go bust, just from sheer bad luck or bad management.
Right, just random noise in the system.
Exactly. And that random noise completely wipes out your 3% buffer. You lose your entire principal just to statistical static.
So the equity holder wants that all or nothing glued together domino effect.
They absolutely do. They would much rather face a tiny 1 in a million chance of a total macroeconomic wipeout where everything defaults than face a near certain guarantee of a few distinct random defaults that eat their tiny buffer. They are essentially betting on the survival of the herd. They want the entire herd to move together.
Because if the herd falls off a cliff, they lose everything.
But they were probably going to lose everything anyway with just a few random defaults. So they're essentially selling insurance on a massive catastrophe, but buying insurance on the day-to-day fender benders.
That is absolutely fascinating. The equity investor and the senior investor are sitting in the same exact deal, looking at the same exact companies, but they are actively rooting for entirely opposite correlation environments.
They are. And this invisible tension is what actually drives the pricing of the CDO. Just like options contracts have implied volatility, CDO tranches trade constantly based on implied correlation. The market prices these different tranches based on exactly how much traders think these specific assets will move together in the future.
And that creates what they call the base correlation curve.
Exactly. And sophisticated traders will aggressively trade the skew, basically placing massive bets that the general market is fundamentally wrong about how connected these companies actually are.
Which, as we all very painfully learned in 2008, the market can definitely be wrong about.
Fatally wrong. The models running Wall Street at the time explicitly assumed that house prices in a suburb of Florida were not heavily correlated with house prices in a suburb of California. They thought real estate is a local phenomenon.
They assumed a correlation of maybe 0.1 or 0.2.
Right, very low.
But it turns out the financing behind all those houses is national.
The financing is national and human panic is global. When the shadow banking financing dried up, it dried up everywhere simultaneously. The correlation went straight to 1.0 overnight. And when correlation goes to 1.0, all that magical protection of the senior tranches just instantly evaporates.
Let's move to the history, because this incredibly complex instrument didn't just magically appear out of nowhere fully formed. There's a very specific origin story here. And it starts back in 1997 with a specific team at JP Morgan.
Yes, the Bistro deal. Broad index securitized trust offering. It sounds like a quaint little cafe, but it was actually the laboratory where modern systemic risk transfer was invented.
Bistro. Sounds like a nice place for a quick lunch.
It was a very, very profitable lunch for JP Morgan. The core problem JP Morgan faced in the late 90s was actually a result of their own success. They had massive, unprecedented exposure to corporate loans. They were lending huge amounts of money to everyone. IBM, Ford, Walmart, the biggest blue chip companies in the world.
And they liked those clients. They wanted to keep lending to them to maintain the lucrative investment banking relationships.
Exactly. But they hit a massive brick wall.
Regulatory capital limit.
Regulatory capital. The regulators came in and said, look, you have way too much risk concentrated in these corporate loans. You need to hold billions more in cash capital in reserve. And holding that capital is expensive. It severely lowers your return on equity. The bank was basically a victim of its own incredible ability to originate good loans.
So, as we talked about earlier, they couldn't just sell the loans.
They couldn't. If you sell the loan, the client finds out, the relationship is damaged, and you lose their future business.
Enter the synthetic solution.
Exactly. A very smart team at JP Morgan, and this is a very famous story in structured finance circles, figured out that they didn't actually need to sell the physical loan. They just needed to sell the risk of the loan defaulting.
So they created an SPV?
They created an SPV. They bought CDS protection from that SPV on their own massive corporate loan book. The SPV then turned around and sold notes to outside investors to fund that protection.
So if the loans defaulted, the outside investors lost their money, and JP Morgan got paid to cover their losses.
Right. And if the loans were good, which they mostly were, the investors got a really nice steady yield.
And the clients, the IBMs and the Fords, never knew a thing.
They never had a clue. The loans physically stayed right there on JP Morgan's books, but the invisible credit risk was transferred entirely out into the global capital markets. And crucially, the regulators looked at it, understood the math, and approved it. They allowed JP Morgan to drastically reduce their capital requirements because the risk was formally hedged.
So this was the original balance sheet CDO. It had a very clear, very logical purpose.
It was an extremely prudent risk management tool at that time. It really was a scalpel. It made the entire banking system significantly more efficient. It allowed banks to support far more real economic activity without taking on existential firm-killing risk.
But then the market evolved, as it always does. It moved from these prudent balance sheet CDOs to something called arbitrage CDOs.
This is where the entire underlying motivation of the instrument shifted. Asset managers started assembling portfolios of CDS, not to hedge an existing book of real business, but purely to capture the spread difference.
Explain that. What's spread difference?
They realized that the total premiums they could collect from selling CDS protection on 100 random companies were often slightly higher than the total coupon interest they had to pay out to the CDO investors who bought the tranches.
So they were basically just mining the spread between the two rates.
They were purely manufacturing yield out of thin air. And this insatiable demand for yield led to the creation of the single tranche CDO.
How is that different from what JP Morgan did?
In the old Bistro days, to get a deal done, you had to sell the entire capital structure. You had to find a buyer for the equity, a buyer for the mezzanine, and a buyer for the senior, all at the exact same time.
That sounds incredibly hard to coordinate.
It's exhausting. It's like trying to sell every single seat in a massive movie theater at the exact same moment before you're allowed to start the projector.
So what changed with the single tranche?
Investment banks got smarter. They started selling just the specific slice that a client asked for. If a German pension fund came in and said, we really want a customized mezzanine tranche referencing these 50 specific European tech companies, the bank wouldn't try to build a whole CDO and sell the rest. They would just say, done.
They would just custom print that one tranche.
Yes. The bank would sell them that one specific slice, and then the bank's trading desk would manually hedge all the leftover risks themselves in the open dealer market. It completely transformed from a banking mechanism into a bespoke suit business. It wasn't about funding real corporate loans anymore. It was entirely about satisfying intense investor appetite for highly specific types of risk.
And then we hit the mid-2000s. The machine gets too big for corporate bonds, and it turns its eye toward the U.S. housing market.
This is the fatal turning point. The mechanism moved from corporate bonds, which, to be fair, are relatively transparent and have a century-long history of reliable default data, to residential mortgage-backed securities, RMBS.
And this is exactly where we get the famous Jenga tower analogy that was popularized in the movie The Big Short.
It really is a perfect visual representation. Think of the CDO tranches exactly like a Jenga tower. The lower-rated bonds, the BBB subprime mortgages, are the wooden blocks at the very bottom foundation. The AAA tranches are the blocks at the very top.
Right. And in a normal, well-built building, the foundation is solid concrete.
But in 2007, the foundation was made of adjustable rate subprime mortgages given to people with no income. If that bottom foundation pulls out, if those BBB bonds default en masse, the entire top of the tower just falls straight down.
But here's the part that I think people still genuinely struggle to grasp about the crisis, the magnification effect. We didn't just have a housing crisis where some bad mortgages went under. We had a global financial crisis that was multiples larger than the actual physical number of bad mortgages. How exactly did synthetic CDOs cause that massive magnification?
This is the single most critical concept of the entire era. Look, in the physical cash market, there are only so many actual subprime mortgage bonds that can be originated. You actually need a human being to buy a house to create a mortgage. Once those bonds are bought by investors, they are bought.
Right. You can't buy more physical bonds than actually exist in reality.
There is a strict physical limit to the bad debt. But with a synthetic CDO, you don't need the actual bonds. You just reference them in a derivative contract.
You can just clone the risk.
You can clone them infinitely. You can create absolutely limitless bets on the exact same underlying mortgage bonds. If a specific BBB-rated mortgage bond from Florida was looking particularly shaky, 10 different hedge funds could short it using CDS. And 10 different CDO managers could simultaneously reference that exact same bond in their synthetic portfolios to sell to investors.
So instead of just the original bondholders taking a loss,
you could have $1 billion of synthetic bets riding on the fate of one single $10 million physical bond.
That is staggering. So a single $10 million bad bond going bust could literally create $1 billion in cascading losses across the global financial system.
Precisely. You didn't need Wall Street to physically underwrite more actual bad mortgages to create more systemic mortgage risk.
Yeah.
They just sat at their desks and wrote more swaps. We created this massive, towering phantom exposure that vastly exceeded the actual value of the real housing economy. It turned what should have been a very painful but contained regional housing correction into a global solvency crisis that almost took down the world.
And sitting on the other side of a massive chunk of those synthetic bets was AIG.
AIG was the ultimate protection seller. Through their financial products division, they were aggressively taking the super senior risk on these synthetic CDOs.
Because their internal models told them it was safe.
Their models looked at the data and told them that U.S. housing prices had never fallen on a national basis since the Great Depression. They viewed selling this protection as literally free money. They thought they were picking up pennies in front of a steamroller, but they firmly believed the steamroller was permanently parked.
They were basically writing flood insurance for the entire world, assuming it would never rain everywhere at once.
Exactly. They were writing insurance on the apocalypse, assuming the apocalypse was a statistical impossibility.
But the real issue for AIG, what actually killed them, wasn't just that they eventually owed the money when the defaults finally happened years later. It was the collateral calls, the margin.
Liquidity versus solvency. This is a brutal lesson for every investor. As the housing market just started to dip, the mark-to-market accounting value of all those swaps AIG sold absolutely tanked.
Right. The market started pricing in fear.
And when that happened, the protection buyers, the massive banks like Goldman Sachs and Deutsche Bank, demanded that AIG post billions of dollars in cash collateral right now to prove they could eventually pay out if the bonds defaulted.
And AIG didn't have the liquid cash sitting around.
They absolutely didn't. They were essentially solvent in the long run.
Yeah.
Most of those super senior bonds actually eventually paid out. But AIG died of a massive liquidity heart attack in the short run. They couldn't poke the margin today, so they functionally failed.
That brings us to this concept of the naked CDS.
Pure, unadulterated speculation.
Right. Investors buying CDS protection on bonds they didn't actually own, it's exactly like buying fire insurance on your neighbor's house.
Right. You don't care if they have a safe home. You don't care if they installed smoke alarms. You actually have a massive financial incentive for their house to burn down.
Which fundamentally changes the behavior of the market participants, doesn't it?
It creates an incredibly predatory environment. It totally changes the incentives of the capital markets, from capital formation building businesses to capital destruction. If you own the physical corporate bond, you genuinely want the company to succeed so they can pay you back. If you own the naked CDS on that company, you actively want the company to fail. You want them driven into bankruptcy.
Let's shift gears here to the investor context, because these instruments didn't disappear in 2008. They were still actively traded today. If I am an institutional investor right now looking at these instruments, what are the harsh realities of the risk? We talked about the tranches, but let's really break down the leverage trap.
This is vital. Investing in a mezzanine tranche of a synthetic CDO is absolutely not like buying a standard BBB corporate bond. It is a highly, highly leveraged bet.
Let's do the actual math on that so people can visualize it.
Let's do it. Imagine you buy a mezzanine tranche that specifically covers portfolio losses from the 3% mark up to the 7% mark.
Okay, so the tranche itself is technically 4% thick.
Right. The absolute thickness of your slice is exactly 4% of the total deal. Now, imagine the whole 100-name portfolio just has a bad year and loses 5% of its total value.
That sounds totally manageable, right? A 5% loss in a normal stock portfolio is just a bad Tuesday. It's a minor correction.
It sounds like noise. But look at how it hits the tranche structure. The very first 3% of that portfolio loss totally wipes out the equity tranche sitting below you. Gone. Zeroed out.
Okay, so there's 2% of loss left over.
Exactly. That remaining 2% of the portfolio loss now violently eats straight into your mezzanine tranche.
And my tranche is only 4% thick.
Yes. You just absorbed 2% of the total portfolio loss, but because your entire slice is only 4% thick, that equates to a 50% loss of your actual principal investment.
Wait, let me just replay that so it sinks in. A totally normal 5% drop in the overall portfolio equals a catastrophic 50% loss for the mezzanine investor.
That is more than 10-to-1 leverage explicitly embedded directly in the mathematical structure. You don't see it borrowed on a margin account statement, but it is mathematically hard-coded there. Advanced models show that these mezzanine tranches can easily have 5 to 7 times the actual risk of a similarly rated cash bond.
This is exactly why they paid higher yields than regular BBB bonds, and exactly why so many people got burned. They looked at the shiny BBB rating from S&P and just blindly thought it was safe.
They completely ignored the embedded leverage.
And that extreme leverage leads directly to what traders call cliff risk.
Yes. In a normal cash portfolio of 100 corporate bonds, if one single company defaults, your portfolio loses 1%. It's completely linear. It hurts a little bit, but you move on.
Right.
But in a synthetic tranche, particularly an equity or a junior mezzanine tranche, the loss distribution is not linear at all. It is stepped. It's a literal cliff.
Because of the thickness.
Exactly. One single default in the portfolio might wipe out your entire yield for the year. The second default might suddenly eat 20% of your principal. 3 defaults, and you were completely zeroed out. You go from making 100% of your expected return to zero very, very quickly. There is no gentle glide path.
We also briefly mentioned negative carry earlier. Explain how that impacts the bank actually issuing the CDO.
This is a really interesting quirk for the banks structuring these massive deals. If a bank sells protection on the entire synthetic portfolio, placing all the different tranches with investors, they are collecting premiums from those investors.
Right, money coming in.
But to responsibly hedge that position so the bank itself isn't taking massive risk, the trading desk has to go out and buy CDS protection on all those individual 100 names in the open market.
Money going out.
And very often, the total cost of buying that individual hedge is actually higher than the total income coming in from the CDO investors.
So the deal literally loses money on day one. That makes no sense. Why do it?
Structurally, yes, it often has negative carry on day one. But issuers rely on what they call breakage, which is investors dynamically trading in and out of the tranches over time, generating massive fees. Or they rely on aggressively managing the unplaced risk, usually keeping the super senior piece on their own books to eventually squeeze out a profit. It's really a massive volume game. They just need to keep the origination machine running hot to realize the trading profits.
I want to really circle back to the model for a minute. We talked about correlation, and the undisputed industry standard for modeling this was the Gaussian-Coppola model, popularized by David Lai.
Yes, the formula that killed Wall Street. It's a bit of a dramatic headline, but honestly, there's a lot of truth to it.
What was the actual fundamental flaw? Not necessarily in the raw math itself, but in the human application of it.
Look, the Gaussian-Coppola is brilliant math. It simplified an impossibly complex multivariate problem by boiling everything down to a single digestible correlation number. It essentially made the unpriceable priceable. It allowed a 25-year-old trader to price a massively complex synthetic CDO almost as easily as they could price a simple stock option.
So it was too easy.
The fatal flaw was the human assumption that correlation is a stable physical constant, like gravity.
They relied entirely on historical correlation.
Right. The model said, hey, look at the data. In the past 20 years, housing markets in Florida and California have never moved down together.
But the past is not the future.
Exactly. The model massively underestimated tail risk. In a true financial panic, all historical correlations go straight to 1.0. When the house is visibly on fire, every single person in the building runs for the exact same exit door at the exact same time.
The beautiful diversity you thought you had in your portfolio just vanishes instantly.
The model mathematically assumed a benign, orderly world. But financial crises are fundamentally not orderly, and they are not benign.
It really highlights the difference between physics and finance, doesn't it? Atoms don't panic, people do.
That is exactly it. Atoms strictly obey the laws of physics. Markets strictly obey the laws of human emotion and fear.
There is also this huge element of counterparty and legal risk. We saw this blow up spectacularly in the famous UBS case.
Oh, the UBS case.
Okay.
This perfectly highlights what we call documentation risk. In a managed synthetic CDO, you have an external asset manager who actively curates the portfolio.
Right, someone has to actually pick the 100 names.
Exactly. But who actually chooses those reference entities?
Yeah.
The manager. And in some very high-profile cases during the crisis, the manager was heavily influenced or even explicitly selected by the specific investment bank that was actively betting against the portfolio.
So the fox is literally picking the hens for the hen house.
And then taking out a massive life insurance policy on the hens. If the manager is conflicted, the CDO investor is just the patsy at the poker table.
And what about the legal side?
You also have massive jurisdictional risk. These deals are so complex that the underlying CDS swap agreement might be legally governed by English law in London, and the actual notes sold to the investors are governed by New York law.
And those two legal systems don't always agree.
They often don't. And when the litigation inevitably starts, and it absolutely always starts when billions of dollars are lost, those tiny gaps and contradictions between the two legal codes can create absolute nightmares for enforcement and recovery.
So we've really stripped this thing down. We've seen the plumbing mechanics, the crazy history, and the hidden risks. Now we arrive at what we call the one question. If our listener is sitting across the mahogany desk from a slick, structured credit salesman trying to pitch them a synthetic tranche, what is the single most important thing they need to ask?
The question has to be, what is the exact correlation assumption driving the pricing of this specific tranche? And mathematically, what happens to my attachment point if correlation suddenly spikes to 1.0?
And why does that specific question matter so much?
Because the baseline rating agency model always assumes a calm, benign correlation environment. If correlation tightens during a panic, your highly rated, supposedly safe senior tranche can suddenly start behaving exactly like a high-risk equity tranche.
It loses its armor.
Exactly. You need to know your exact break-even default rate in a full-blown systemic crisis, not just on a sunny Tuesday. You need to know for a fact if your money survives a Category 5 hurricane, not just a light drizzle.
Powerful stuff. Let's wrap this deep dive up with our key takeaways for the listeners.
Number 1, synthetic CDOs fundamentally separate credit risk from physical funding. They allow for the pure transfer of risk without actual ownership of an asset. This is incredibly efficient for global plumbing, but it dangerously disconnects the abstract risk from the physical underlying asset.
Number 2, the tranche structure inherently creates massive leverage. A thin tranche is a highly leveraged, concentrated bet on the portfolio's default rate.
Right, so do not mistake a credit rating for a safety guarantee. A BBB-rated synthetic tranche is infinitely riskier than a standard BBB corporate bond.
And number 3, correlation is the invisible killer. It is the primary mathematical driver of value differences between the risky equity and the safe senior tranches.
When you buy these, you are not just betting on individual company defaults. You are aggressively betting on the interconnectedness of the entire global economy.
Final thought to leave you with. Are these instruments inherently evil?
I don't think so, no. Financial instruments are just inanimate objects. They're math. In the right, prudent hands, a synthetic CDO is a surgical scalpel for hedging real balance sheet risk and freeing up trapped capital for productive, real-world lending. It creates vital liquidity.
But in the wrong hands.
In the wrong hands, as we all clearly saw, it is the exact bomb that blew up the global economy in 2008. It artificially amplifies leverage and hides massive concentrated exposure from regulators.
The key is just knowing which version of the instrument you're actually holding.
We know exactly what you hold.
This has been Talk Tickers. Class dismissed.